in real estate, we're going to call $3,000 virtually no money, to a $25 million portfolio in just over 4 years. 2 years of that was with partnership. The first 2 were without. So whether you have a partner now or you don't, this is repeatable. Now, stage 1 is what we're going to be talking about. We have our 4 phases. We only touched on 2 of them earlier.
What was phase 2?
Stabilization. That's the actual management of the property. I'll go through this really quick, and then we'll actually jump into the numbers. So phase 1, which is where these numbers really come into play as far as scaling, that's your build phase. Then you've got stabilization phase, optimization, which we'll talk about. That's pushing every asset you own to highest and best use. And then stage 4, which is also really important to know your numbers on, is how you actually pay it off. It's cool to buy real estate. It's cooler to own it. And the way to own it is to pay off all your debt. So we're going to talk about how you actually super cycle through your portfolio and pay it all off. And Christian and I, there will not be a single property that is outside this rule. We will own everything we own today in cash by the time he's 40. By the time I'm 30.
Let's go!
Let's go for being younger. All right. So the first things we have to go over, and we're not going to talk about anything like IRR because the alphabet soup doesn't matter. We're going to start with a cap rate. Cap rate is more important than some people think. Does anybody here know what a cash-on-cash return is? If I invest $100,000, I get $6,000 back at the end of the year in cash flow. That's a 6% return. The only difference with this is there's no debt involved. So if I buy a $100,000 house in Tennessee and I get $6,000 back at the end of that year in cash flow, it's a 6% cap rate. So this is just your dividends, and this is really important to write down for later. This is your dividends expressed as a percentage. This is directly tied to something we're talking about later. Next up, you have your debt service coverage ratio. For anybody that is writing down equations, it is important to know your equations. All you're going to do, this has to do with something called your NOI, that's your net operating income, and your debt cost. What is your actual debt cost on an annual basis? So your NOI is the money you have, if you're not familiar, to pay yourself and pay your mortgage. And that's it. So if you own a property in cash, that's the money you have to pay for your mortgage. So the equation is your net operating income divided by your loan cost. Not your loan amount, but anybody in here can go on Google mortgage calculator, and you can put in whatever your debt is going to be, whether it's 6%, 8%, 2%, 30-year AM, 25-year AM, interest only, and you're going to have your debt costs. So you have your NOI above your debt cost. Now, who knows why this matters? Just to raise your hands if anybody knows the answer. Aaron?
Debt service coverage ratio?
Yeah, why does this matter?
If you're trying to get loans, banks are comfortable. They are only comfortable with a certain level of debt service coverage being higher than 1-to-1, obviously, so 1.2 or whatever.
And why is that? What does this represent?
Risk, I think.
How so?
Well, it's risk protection in case of vacancy and that sort of thing. The rents will cover it down to a certain level, I guess.
Risk on what? Does anybody know?
Well, it's a liquidity ratio, isn't it?
This is on your cash flow.
Vacancies and...
Yep, so if we look at this, the actual equation, I'll just write it here, but you've got your net operating income. Again, this is the money you have to pay yourself and pay your mortgage, and it's over your loan cost. So if we put this with actual numbers, if we have a deal with an NOI of $125,000, maybe you have a 20-plex somewhere, and we've got an NOI of $120,000. If our debt costs $100,000, maybe you've got a $1.7 million loan at 6% interest only, and you got a $100,000 debt service. We have $20,000 in cash flow, meaning that our debt coverage ratio is 1.2. The higher our ratio is, the higher our cash flow is in excess of our mortgage.
Is the loan cost always counted as interest only?
Nope.
The interest portion?
Nope.
Or,
I just did that number because I knew that number in my head. 1.6 million, 1.7 million at 6% interest only is $100,000 a year.
Okay.
But the higher your ratio, the faster you can save for your mortgage. Another example, I bought a 12-plex in Quincy. It was my very first building. corner lot close to Microsoft over in Quincy, Washington, which is just north of George, Washington. If you haven't heard of it, that's okay. I had never heard of it either. But I invested there, and when I first got started, the NOI was a little north of 90,000. It was like 95,000 and change. My debt service was 72,000 to the seller. So that mean I had margin. I had north of $20,000 to borrow my down payment. The higher you get this ratio, the more likely you are to be able to borrow the down payment and actually get into the deal with zero down. And there's a few ways to actually increase your debt coverage ratio, which really just means increase your cash flow. There's only 4 ways to increase cash flow. The first, there's 2 categories too. You can optimize the real estate, or you can optimize the debt. That's it. And optimizing the real estate could look like, I'm going to raise rent. You buy the property, maybe you put some money into it, and you raise the rent $25, or $50 or $100. On a long period of time, that will increase your net cash flow, especially when you have more units. You could also decrease expenses. Those are the standard ones that people look at. Optimizing the debt could look like borrowing less money or borrowing cheaper money. If instead of borrowing $1.7 million at 6%, you borrow $1 million, now your debt cost is $60,000 if it's interest only. So your debt 2. Now the reason it's important to look at it like that is when I first bought my deal, I was net cash flowing like $800 a month, and my total debt payments were almost $7,300. Not a lot of extra room for margin. There wasn't a lot of extra room for risk. So while I could buy real estate zero down, we have the principles of you have to establish 2 things. How do you buy it? How do you never lose it? If your debt coverage ratio stays around 1.2 or less, you're in jeopardy of losing your real estate. So if you're going out and trying to buy real estate, whether you do it seller finance, you do it through a bank, you do it fix and flip, you should have a means to get this number to 1.5 minimum within a year. And we've been able to do that on every project that we bought outside of our development sites. We have 2 development sites that are not going to cash flow. But every apartment building, we can get above 1.5 within a year. That is just a safety metric for how you keep it for the long term, because that means every 2 months you save up an extra mortgage payment. Puts you in a very low risk position.
Is that for primary loan only or combined loans?
So you can do it, the equation's on your total loan cost. So you can do it on your first loan if you're doing seller finance, and you can also run it with if you're borrowing the down payment. But if I'm borrowing the down payment, it's typically for 2 to 3 years. That's a shorter term deal, and I have a plan to pay it off. So I'm going to be underwriting for this, the 1.5, on the seller finance loan because I have a plan to pay off the down payment. We'll talk about it in the future.
So just one last clarification on the loan cost. If you are doing a principal and interest loan,
Yep.
then it's the principal and interest that is the loan cost.
Yep.
Right? Okay, so total loan cost, whatever type that you have.
Yep.
Okay.
That's it.
I have one last question. So when you say total loan cost, you're just talking about what you have to pay them for the year?
That is your annual principal and interest payments.
Thanks.
You're saying a 1.5 for like apartments on different asset classes you go higher. Like the hotel conversion, do you, since you're going to take a loss in the beginning, you go for like 2 or something?
Well, the thing is, if you're doing a conversion, you're not going to be there day one. So if you're at a 1, that means you cover your debt. It's a 1 for 1. If you don't make any income, you're less than 1. So if you're doing a conversion, yeah, that's going to be way higher. On the hotel conversion, we're going to have an NOI of like $130,000, and our total debt payment is only $50,000 a year. However, it's well above 2, but if you want to increase this, you borrow less money. We're going to refinance and pull more money out. So we're going to bring it to a 1.5, so that if our payment goes to, let's say, $7,000 a month, we've got an NOI of 11. If it's 7 versus 11, our payment's going way up. However, we're pulling money out of the asset to get liquid.
And this part to just pay off the people in the deal.
Correct. You can pay off other people in that deal, or you can pull money out of your value add projects to pay off the passion projects. We're going to talk about this a little bit at the end, but one thing that Christian and I are doing is we're going and doing a bunch of value adds elsewhere so we can rip money out and pay off stuff like the Robin Hood. There is some stress for Christian, because Christian runs this, and the people, with actually managing this in the meantime. When it's paid off, there will be a lot less stress. So that's the goal.
Tax and insurance, sorry, is not included in the loan cost?
Taxes and insurance are a function of NOI. So if you're looking at net operating income, you're taking your total gross scheduled rents for the year, less vacancy. So if your vacancy is projected at 5%, subtract that out. Then you got to subtract out taxes, insurance, maintenance, management, utilities.
Yeah, I forgot about that, sorry.
Are you underwriting at like flat rate percentages or are they line items?
They should be line items until you've done enough deals to know the percentages.
Okay.
Go through the reps. Don't just use a blanket answer. I know for a fact that our stuff typically is going to be around 37% expense in Moses, and when we get rents up, the percentage goes down to about 32 to 33.
Gotcha.
What?
Is increasing this ratio by increasing the amortization period a good strategy?
Absolutely. That's how a lot of people play the game in Seattle. And we're actually going to talk about that in the next, I guess this is not a slide, this is a sheet. But yeah, absolutely. You can change the amortization, you can change it to interest only, there's a lot of ways to make it work.
I think you might have just answered it, but anytime you're under the 1.2 debt coverage service ratio, it's a good time to go back to whoever your debt is and be like, let's restructure this debt and delay payments.
Well, it'd be in your best interest too, but they're probably not going to restructure if they already gave you the loan.
Sure.
But absolutely.
But if your pro forma says that before you make the purchase, right, you're negotiating.
Yeah, and this is the flaw with a lot of people's business models. They'll buy a deal in a core market with whatever the debt product environment is, and they'll have a pro forma of taking it from break even to 1.2. And that's a bad place to be.
And you gotta start with 1.2 to go to 1.5.
Yeah, or start at 1.5. There are some deals where you can do that.
Nice.
I don't see Caleb in here, but he just bought a ridiculous deal, the 25-plex.
Oh, geez, yeah.
Yeah, he's going to cash flow like $9,000 a month, and his down payment was a few $100,000. But
Yeah, I think he did 150 down, I believe. Might not even have been that.
yeah, so I mean, he got a ridiculous cash flow in excess of his mortgage payments, and so as a result, he started I think above a 2. But it just comes down to what you negotiate. So
based on terms.
it's all based on terms. And one thing to map out, price is one thing, terms are everything. If someone in here bought a deal for $1 million and sold it for 2, what's their ROI?
Depends on it.
Huh?
Did they pay cash?
That's the right answer. Right? There's one more input. Your ROI is highly determined based on the money you have into the deal. So if you put, you paid cash, then you double your money. If you do what most people do, you turn 300 into $1.3 million. If you do what we share to do, you turn 50 to 100,000 to $1.05 million to $1.1 million. ROIs, returns, I mean, price does matter, but the terms are way more important because you can absolutely explode your returns in real estate if you put less down.
Yeah.
Question is, how do you make a cash flow? And
Right,
that's
'cause that's the balance, right?
But-
It's finding that spot where it still cash flows healthily,
Mhm.
right?
And that is a function of the next page. So, does anybody know what a factor rate is? You know it.
Good, only because I did your program.
Okay. Shout out. There we go.
Take credit for that.
Okay.
You said it was the total cost of your debt, so principal and the interest, right?
Uh-huh.
Together as a percent.
Yep. So everybody is familiar with an interest rate. That is the amount of interest you pay it, that doesn't get applied to what you owe. So if you have a 6% interest rate, we'll just do it on a $1 million loan. So I'm just going to use M. At 6%, then our cost is $60,000 per year. All right. If we do $1 million loan at, let's just say 6% interest, but it's amortized, we'll do the same thing. What's the payment? I don't expect you to know that one, but it's $72,000. So if we do that, all I did to know that is a mortgage calculator on Google. That's it. I don't know how to do it in my head. So if you're at 6%, then you're at 72,000. Same interest rate, but if you're amortized, your payment's higher. Now the question I ask myself is, how do you quantify that? How do you assess risk? How do you make your deals cash flow when you don't know the difference? Because I sure as heck don't know how to quantify the difference when I was getting started. And I learned about these during COVID when I got sick and I was on my couch for 2 weeks, right before I filmed Bigger Pockets. And so what I figured out is one is called an interest rate. You have 6% interest rate, but your factor rate is directly applied to what Hamed was asking about, which is your amortization. The equation for your factor rate, we put that down here, it is simply your principal and interest on an annual basis divided by your loan amount. That's it. So if you just go onto Google, you put in a mortgage calculator, what is my payment? And I'll send everybody, I think we have everybody's email. We can send out the spreadsheet that I built during COVID because I was trying to quantify this. I made so many mistakes, so I've got like a million slides that I had to hide. But this is the equation. You have your annual principal and interest times 12 divided by the loan amount. And what that gives you is your factor rate, but it doesn't mean anything if you just see a spreadsheet or you see numbers on a page. It matters if you know what it means. Factor rate is expressed as a percentage, your true cost of capital. That is the cost of the money, period. And the reason that this matters, this is how I can analyze any deal in my head rather quickly, is because that's your true cost. And if we go back just a couple slides, this is your net dividend. One is higher than the other. If this is higher than your cost of capital, you will make money on every dollar you borrow. And you can borrow indefinitely. That's the beauty of the deal. Your cap rate's your cash on cash return if you pay cash. You pay cash for every single property that you buy. It's just not your money. So if you're writing things down, this is your dividend as a percentage. And your factor rate is your cost as a percentage. You have to make sure your cap rate's higher than your factor rate. If you do that, you just know those two equations, you're set. And for those who don't know the equation on your cap rate, it is just your NOI, NOI divided by the price. That's also a way to figure out your value, which we'll talk about in a minute. Does anybody have any questions on this?
Go ahead.
I was wondering the other page. You're saying there's like two different ones, the amortized one, and what was it talking about?
So you have interest only and amortized.
How come they're so drastic in the amount? Is there a benefit to doing it amortized in the long run?
Amortized will pay off all your debts over time. If you amortize your debts, you pay them off a little bit over time, then yeah, you're going to pay it off. You'll own it in cash. The reason that I would opt to do interest only, number one, it maximizes your cash flow. That's what everybody says. However, the reason it's really important, if you have $1 million loan and in year 25, maybe you owe, you probably owe like 200 grand. If you lose the property, it's probably worth $2 million. You owe 200. You go to the hospital. You don't have anybody to help make payments. What happens to the property? Are you going to get it sold at highest and best value to recoup all your money? Probably not. But the seller has already got paid all their money, plus all their interest. They have very little risk in the property. Whoever has the most money in a piece of real estate holds the most risk. So rather than delevering the seller, I want to owe them as much money as possible until we get to stage 4 in the business cycle. We debt hammer, we can pay cash. So if you have the option, do interest only on your whole portfolio, stack all the cash flow, and when you want to pay them off, take all of what could have been amortized on all your individual properties and just hammer one deal. Does that make sense?
Yeah, that makes sense.
Cool. So how this works in practical application. What is our factor rate on $1 million loan at 6% interest 30 round. Using this equation, we have $72,000 a year in payments on $1 million loan. What would our
1.1,
factor rate be?
7.2.
7.2. We take the total payments divided by the loan amount. So what cap rate do we have to buy at to make money?
More than 7.
More than 7.2. So if you bought on a 7.2% cap rate, what's your cash on cash return? Could be any size deal. You buy a 7.2 cap, and your cost of capital is 7.2%. What's your cash on cash return?
0.
Nope.
100%.
Nope.
What?
Nope. All right, we'll do it on another page. Oh wait, we have to skip that one. That one's related. We'll talk about how to make $1 million for everybody in this room. So we're gonna buy a deal, and let's say it is, what would be a round number? $1 million?
$1 million.
Okay. So we buy $1 million deal, and we're gonna put 200 grand down because we're a big baller. So we owe, we're gonna owe 800,000, and we have a loan for 800. Okay. If this is a 7.2 cap, what is our NOI? $1 million. Cap rate is just the purchase price times cap rate. We'll have our NOI.
72,000.
72,000. So if we're buying a 7.2 cap, then we have an NOI of 72K. Our debt service on this, 6%. Can you just fact check me? I think that is going to be 4,800.
So if you're dealing with a 7.2 factor rate,
Uh-huh.
for cost of capital, I mean, and generally to be safe, you're looking for a cap rate that's a couple of points higher than that, right? Or I mean, as many points higher as you can get.
Exactly. So how can we make this deal better? Without changing the interest rate, how can we make it better?
More down payment?
Well, I mean, you could borrow less money, but you're still going to earn 7.2% because you're going to break even on this and earn the same on that. This is how we can make deals work. If our return right now is 7.2%, we want to up that. What if we went interest only? If we did 6% interest only, then our loan is going to cost $48,000 a year instead of $4,800 a month, and we're going to cash flow an extra $9,400 a month or a year. So if we do the same situation, let's do 6%, and in real estate IO, it's just is short for interest only. We're gonna have the same NOI, nothing else changes. Our loan, all I did was take 6% times the 800,000, 48K. So we have 48K and we have 72,000, meaning that our cash flow is 24,000. So instantly, without changing an interest rate to a seller, your cash on cash return went from 7.2 to 12%. And you just made that deal really attractive. If we took it to 5%, we save another point on the debt, that'd be another $8,000 a year in cash flow. If you went to 4%, it'd be $16,000 a year in cash flow. Extra, just off the debt alone. And now you're making money off other people's equity that they spent decades to build.
And your cap rate's not changing because the purchase price and the NOI aren't changing.
Yep. Purchase price, and this is how we can make deals work with sellers. If they're stuck on, maybe they want to make 6%, maybe, like let's say it was a big deal. If it was $10 million on a loan, because anybody could do that deal, Eventually, you build up to it. A $10 million loan, if it was amortized versus interest only, think about the amount of money you could save. I mean, you just add zeros to these. It gets really big really quickly. And maybe they are just stuck on their price and they're just stuck on their interest rate. If you do interest only and they want a 5 cap, borrow at 4% interest only or 3%. And now you make 1-2% on every dollar you borrow. And that's how we can make sure that we make money on every deal we buy. Because if you make sure that your cap rate's higher than your cost of capital, you will not negative cash flow, ever. It's mathematically impossible.
So what keeps people from going and just doing the bottom one? Is there an advantage to doing the top one?
Absolutely. The very first 12plex I ever bought, when I bought it, I owed $1,012,50. Now I own like $955, $954. A few years, I'll owe $900. Give it some more years, I'll owe $100. Like it'll keep going down. I don't have to think about it. The problem is, if I went interest only on my first deal, I would have had an extra $1,000 a month cash flow. And I could have used that, especially in the early years. That would have helped out a ton. Yep. And as rents go up, then my NOI goes up and my debt stays the same. That's why the fixed rate thing matters so much. So it gets easier over time and your returns go up over time. But in the beginning, if you can get interest only, that's when it matters most. Because conserving cash flow in the beginning when you don't have a ton of extra money coming in, you don't have a bunch of equity you can pull, maybe you don't have a deal you can sell out of to get the money you need to do a down payment on another one. Every dollar matters.
I see. So like more cash flow, more equity. The different strategies. Like you'll gain equity faster on the top one. You'll gain more cash flow on the bottom one.
Yep. However, if you reinvest the cash flow from this one, you might be able to outscale the equity pay down you got on this. There's opportunity costs in business, and every time that I can get extra cash flow, as long as it's long term, don't do interest only for like 2 years, 3 years, but you want this for long periods of time, you can use the extra money to pay down other deals, or you can use it to invest in other deals.
And then it's like when you were talking about the other loan where the guy had the 0% because he wanted like the tax thing.
Yeah.
He didn't want to get paid out for 5 years.
Uh-huh.
The other guy didn't care as much.
Mhm.
If you go into like an interest only loan, is there sometimes stipulations where like you can't pay more than the amount because they want the loan for the long term? Or can you use that extra cash flow to just be like, all right, this month we did a lot, this quarter we
It, co- it comes down to what you negotiate. However, sometimes there are prepayment penalties. There's this thing called yield maintenance on some loans where there's a guaranteed amount of interest you'll pay. So on larger agency debt products, sometimes you have yield maintenance, which says you will pay 5 years of interest regardless of when you pay it off.
Isn't it just putting in the terms of the note saying interest only or more?
Interest only, and you accrue interest on the amount that you owe.
No, but I mean in the note terms, if you add the verbiage of interest only payments or more, you give yourself the option of paying toward the collateral or to the principal.
Yeah. However, the actual verbiage is just more like you accrue interest on the amount that you owe. It's the outstanding principal balance.
Yeah.
So if you paid it down, your payment would actually be less. So example, on the Robinhood, we have an interest-only payment based on 4.5% interest only. We have an additional down payment every year that we negotiated. So now, starting next month, our payment is like $870 a month less because we chunked down the mortgage.
Okay.
And then next year, we have to chunk down the mortgage again, and it'll be $800-something less.
But then also sometimes like sellers would want like a minimum payment, or sometimes they want like a minimum payment per month.
Yep.
Even if you're paying down like the principal.
Absolutely. And that's why it's so important to build relationships with owners so you learn what they're looking for. I work with someone and their only goal is they want to earn 6% on anything that they lend. Doesn't matter if it's hard money or a brand new development. They want to earn 6%.
Yeah.
So that's always the interest rate. And so we're working on buying a brand new development deal. There's a 25plex and there's a 14plex. It's like a 6.5 cap. How do I make it work? My first deals with them were amortized. Can't do that on new construction, so I do interest only, and I still make 0.5% on all the borrowed money, which is a lot because on new construction the price tag is big.
Yeah.
I was wondering when you structured your down payment and you So basically, you restructure it every year based on how much of the principal that negotiated in the purchase and sale, or
So since it's interest only, you pay interest on what you owe. And they specified they wanted specifically additional down payments every year. This is also how we bought our Tequila deal that Christian negotiated. We bought it 4.5% down, 3% interest. And to get such low money down on that sevenplex, we have additional down payments of $20,000 a year. So every time we pay it down, our payment can go down for the interest portion. Same on this. So if I get what you're saying, like you think you have to negotiate it, but if your note is written, whereas it's just interest only on the outstanding balance, every time you pay it down, it'll auto adjust.
that's
Yeah.
exactly what it's for.
And then make sure you use note servicing. You're not just making the payments yourself every month, but you have a note servicer that's actually going to take care of that. It can be annoying to track the interest. All right. Does anybody have any questions on that before we move on?
Oh, hold on. So on the down payment, in this scenario, we're assuming the down payment was a cash that you had and not private money loan, right?
Well, the cash comes from somewhere. If you have a cost on that, then you have to account for that on a global cash flow perspective. But the deal doesn't care where you get the money from, nor does the seller. So if you have a cost on this at 12%, you have to do 6 IO to break even. Because that's where your cash on cash return matches your cost of capital on that down payment. But if you're borrowing at 12%, you don't want to just earn 12%, so you probably have to borrow cheaper than 5 or 6% interest only.
Okay. So you just add that additional interest formula on top of the
Yeah,
to make sure that the whole thing is.
And we have a spreadsheet that'll map all this out for everybody. It's super easy and it's colorful, so it's either green or red. Red doesn't work, green works, so it'll make it really easy. But we'll get that out to everybody today. But you just have to make sure that if we do this equation, you have net cash flow. Net cash flow is similar to NOI, so if you're borrowing the down payment, you have this amount of money to service your down payment loan if you're borrowing it. And that's how I mapped it out to make sure I can go buy stuff and cash flow it.
And in a scenario where you're going into it knowing that you're going to repair it, you try to work backwards from that, right? If this is when we want to repair it, this is how much we estimate, and this is how much we want to cash flow additional. This could go into it.
Yeah, but this is the total amount of cash flow you could dump back into the property. So you may have to raise more money to fix it up because while $24,000 is a nice pay increase for everybody, that may renovate 2-3 units. So if you have a big reno, you should probably just budget more that you have to raise. And
We're
then
also not getting that at the beginning of the year, so that's at the end of the year, which means you'd have to wait all that time to do any renovations.
for what?
Just the 24.
Oh yeah, that's broken up every month.
Yeah, so that's not like a lump you can go renovate with.
Right. Absolutely. Unless, we will talk about one more thing with math before I go to million. When you buy real estate, you're buying a business and you get all the good books and the bad books. One thing that we didn't touch on the 38plex that we did, this is important for people that maybe don't like numbers to keep it simple, but there's this thing called a tenant ledger. This is a good way to creatively finance your renovations. We bought the 38plex and we got paid a couple $100,000 to fix up the building before we refinanced because of these things called tenant ledgers. So a ledger just outlines your debits and your credits. So you've got charges on one side, you've got credits when people pay into it. And so we'll just do a ledger for Christian, because Christian actually leased our building at one point with me. If you've got a charge, let's just say you've got a charge of $800 for rent, and this is for January, February, March. If you missed those 3, we'd have an outstanding balance of $2,400. We had that on the 38plex for well over $100,000. There are housing authorities that you can take this to. Just keep track of your numbers. You can submit this and get all the money in on that note of renovating. We took tenant ledgers for, not Christian, but tenant A, B, C, and D through a complex that was not paying, and we got 6 figures worth of checks to renovate, lump sum up front.
From who?
From the housing authority. Because we bought a business that had bad books and we fixed the books. If you bought a cleaning business and you had a bunch of bad debt and you claim that bad debt, who's entitled to it? Be you, because you fixed it and you own the business. So you can take your ledgers to the housing authority. There's a lot of different local housing authorities, and you can get paid for back due rent even before you owned it. You'll get taxed on it, but I did this with my buddy. He bought a fourplex VA, my buddy Paul. 0 down. We got closing costs covered by the seller. There was a tenant that was back due $23,000, and guess who bought a deal 0 down and got paid $23,000 to buy it? Paul, because he took this to the housing authority and got paid to renovate 2 units.
Why does housing authority give you the money?
Because housing authority doesn't want people to be homeless.
Does that only apply here in the state?
I don't own anything out of state, so I don't know. But I know that in a state where they really don't like homeless, there's a lot of programs that will help back to tenants.
So it's not low income, it's like any.
No, I've had people. We had someone that was making $160,000 a year living in Gibby,
Oh, jeez.
and we got a check for $7,500 to pay the back to rent. They just weren't paying.
Are you required to keep them after you get that check, or can you kick them out after you get that check?
Well, in Washington State, there's a lot of notices that go on. But if they're paid up through next month, I can't kick them out.
But I mean, you don't have to sign something that says, I will not evict this tenant within a certain time period.
They have a form. I don't think it's a RHA form. They have it's a housing authority specific form, and then you have to provide a ledger.
Mm-hmm.
There's some contract that you have to sign.
It's fairly simple, and
Very
all
simple.
you can actually fill out everything, like literally everything for the tenant. They just need to sign it. So like, you have tenants who just won't do anything. You can just basically fill out every detail for them and say, look, you can get caught up on your rent, or you can sign your name. Like those are the options. If you can just get a signature, we're good.
And we got checks. The largest check was the 23 from my buddy Paul, but we've gotten checks for $8,000, $10,000 plus. Multiples within a month, where the checks we got for back due exceeded the performance of our whole portfolio combined. I mean, it can help out a lot because it's a lump sum and it's back due rent, and you can get it from before when you owned it.
So when you said you fixed the books, what did you have to do before you brought, like, what did you have to do to bring to the housing authority?
So the tenant ledger should look like, okay, you have a $800 charge, then you have a $800 payment, and then it goes back and forth and zeroes out at the bottom. However, with a lot of tenants, especially when you're buying a value add building, it's just charge, late fees. So you need to make sure you have an accurate representation. You can chat with them and say, hey, I'm working on a program to get you caught up. How long have you been behind? And don't worry, you're not going to have to pay a dime of it.
So do you actually create a proper
We
record
do.
from the crappy books?
We do.
Okay, that's
We
fine.
try and get the information from the owner before we buy it. That way we don't have to work with the tenant to make it up, because they're probably going to say, well, we only owe the last 3 months.
Right.
And I'd rather get the last 8. But you have to work with the pieces that you have. And then you create those based on the knowledge that you've got, and you submit it in. And this is how we funded a lot of early rentals. So
When you say charge, you mean you're charging off bad debt?
the charge would be like a rent or a utility bill that you're passing on to them. All right, we're gonna move on. How are we on time, Christian?
We got like 5-10 minutes. A little bit less if you want some questions.
Okay, I'll go through how to make $1 million really quickly, and then we can go to Q&A.
Buy one good deal.
Oh yeah, just buy a deal. There. Steps complete. So if you want to make $1 million, the reason we said buy 20 to 50 units, there's next to no competition for them. And there's some, but in comparison to what Bigger Pockets hyped up is the house hack, 1 to 4 units, a lot of competition there. And a lot of people that did that 5 years ago are now trading up. They're getting adventurous buying the 8plexes. So you are far enough ahead of the hype to just buy deals that make sense, that don't have a ton of competition. So if you want to make $1 million, first thing we got to go back to is, what is a cap rate? It's a cash-on-cash return if you pay cash. The reason it matters, that's your dividends. That is a dividend that you could expect to get in any area. If you're buying a multifamily in Union, a little bit risky. You probably want to earn 8% on your money, so it'd be an 8 cap market. If you're buying in Seattle, it's a 4 cap market. So $1 million property has to net $40,000 a year. If you increase that number, if you take it from 40 to 50, what happens to the value? It goes up. So that's how we do this. Make $1 million, what we did on the 38 plex. If you go out and you just say, I'm going to buy a 20 unit complex. I'm going to buy 20 apartments at market value. You're not getting the steal of the century. And we're going to just write some things out so we remember. It's a 6% cap market. If we buy it at value, it doesn't matter what we pay for it. It's just a number on a piece of paper. What does matter is what we can do to it. We can increase the NOI by increasing income or decreasing expenses. And because the government likes to take their share, it's not usually easy to decrease expenses because they're going to raise taxes and your insurance is going to cost more. When we bought this property, our insurance went from $2,000 to $20,000. Oops.
Surprise.
We were going to inherit the other insurance, and they said, oh, we don't do that anymore. So insurance goes up. Your costs will go up when you buy real estate. So instead of focusing on lowering costs, which can only go so far, we want to focus on how do we add income. There is a 20 unit in every market in the United States, without exception. I haven't found a market yet that doesn't have one, where rent could go up $150. That is a fact. So if you get rent up $150 on 20 units, that's $3,000 a month in net income. Your expenses did not go up with that. They're just paying more. $3,000 a month, $36,000 a year on a 6% cap rate is how much? 36 grand divided by 6%. It's $600,000. We didn't quite make $1 million. So all you have to do this deal is figure out how much would rents have to go up on this amount of units. If we raise it $300, and the answer is $250, but if we raise it $300, $6 grand a month in new income, $72,000 a year, you're gonna make $1 million. It's just math. It's new net income, and the reason that this works is if you're buying it at market value at a 6% return, it makes more. Someone could pay more and make the same amount of money that you did, just cash on cash wise. They'll make the same and earn the same return you did. So if you raise rent $250 on 20 units, $5 grand a month, 60 grand a year, that's a 6% return on $1 million. You could sell it for $1 million more, and they would earn the same return that you did. That's the beauty of this game. When we bought 38 units, our average rent went up like $400. So you can do the math. But there are deals like that are mismanaged where you can come in and get the rent up just a little bit. Whether it is cleaning up the complex, we had someone that I mentioned earlier named Cruz. I mean, they had face tats from their head to their toes, a massive gun on their side, just walking around campus like they own the place, not paying rent for years. Scary individual. I'm not going to raise rent $250 on the neighbors until he's gone. Would you agree? It's not going to happen. So you may have to remove some questionable individuals. You might have to renovate some units. It might be as simple as saying, hey, rent hasn't gone up in a while. Market rent's $1,000, your rent's $500. I don't want to take you all the way up. We're going to meet in the middle at $750. That's called the binder strategy. Dion does it. And he can get his rents up 30-40%, and the tenants are happy about it. You're just letting them know where the market rent is and that you're not going to take it all the way. There are deals like this everywhere. There's deals in Tacoma, Lakewood, Indiana, New York. You can find them on the MLS. This is how we do every deal that we buy. If you do it, so again, math on this, $250 rent bump on 20 units. What if we did it on a 30 unit? That's not going to be an easy number. That'll be like $170. But it just gets easier and easier as you get bigger. And that's the beauty of it. If you can do a 50-unit complex, I mean, you're just north of $100. Actually, you would be at $100.
Yeah.
Look at that. That's easy math. If you can buy 50 units and get rent up $100, I mean, there's got to be 50 units in any market that you can raise rent $100. You will make $1 million in value add in a 6-cap market.
I mean, even if you have to buy a couple buildings.
Even if you bought 5 10-plexes.
Yeah.
That's exactly how we built the portfolio we did. And when I mentioned earlier, if you want to get to 25 grand a month, 300 grand a year to retire, get $5 million, buy $10 million real estate, and get it to be worth 15, paying you 6%. This is the math that we use. If you bought at 200 grand a door on 50 units, you bought $10 million of real estate, you got the rent up $100, you have $15 million of real estate. You're done. So you just have to figure out how to get into the deals, which is deal then debt then equity. We talked about that earlier, DDE. And you just have to figure out how many units would I have to buy to get the value up enough for someone else to see it. And that is how we've ripped out a few $1 million out of the portfolio liquid and built a multi-7-figure equity position in a little over 3 years, 2 years together. Does anybody have questions on this? Makes more money, it's worth more money.
So how do you get the tattoo guy out?
That was fun.
Eventually, eviction.
Share it. So we have on a 38plex, we've got an L building that looks like that, and then we've got buildings over here. And he jumped out the window when cops went in this way.
Oh, is this Cruz?
This is our tenant, not our tenant anymore.
Did you put a trampoline out there for him at least?
A single-story building, he survived. But cops go in this way, and he has a friend over here, so he goes in this way. And due to COVID, we can't force a guest to leave. And he was a guest, so then we had to work on eviction there.
You have a plan.
He had a plan. I'm sure he had a friend over here, but we got them out. So, unfortunately, Washington State can be a little bit tough. However, there are people buying in any market. There are people that will make money in any market. And if you have a solid plan, if you want to keep your real estate or you want to sell it, you can get massive exits that will fund your future deals. And this is how we do stage 4 in our business cycle. You do your debt cycle, your debt pay down. We're going out, we're doing some value add projects out of state, like the one we mentioned earlier. We're getting the value up, we're going to sell it, pay the taxes, and use all the money we make on those value adds to pay off everything here. You don't have to keep everything forever, but build a foundation, something you can keep forever, and then go do stuff like this in markets you don't need to own in forever. Sell the asset, get the money, pay off your debt, and you're out of the game.
Kind of a question I asked at the workshop was about, using money to live on from these first few deals.
Yep.
I'm just curious, you guys are doing this full time. So where are you carving out your living expenses from?
Out of everything, we've got about $25 million in real estate with 15 in debt. We pay ourselves $5,000 a month each.
So you just how long did you wait before you did that?
I didn't pay myself next to anything in the beginning. We didn't start paying ourselves till last year.
Yeah. What helped is we did one refi of one property partway through, where we both pulled out about $100,000, and that was more than enough to live. Like $100K, you can live on for a year, no problem. And then the rest of it, personal and minimal salary. I also have a wife, so the PM company pays us a little bit, and the Cody and I, various companies pay us $5.
And you do have to find a way to, you have to spend money. So what that might look like is you go do a deal where we just bought a 24plex, and we bought it for $1 million. It's a hotel conversion. We're getting the rents up as a standard rental, and it's worth 2.3.
And when
You don't-
go ahead.
I was just gonna say, if you could sell it, walk away with $1 million, and you could live for a long time and figure out how to do the multifamily thing.
Yeah.
That was just a random deal that popped up.
Yeah.
You could also refinance it, get a loan for $1.2 million, pull out 200 grand tax free, and call it a day. Keep the asset. It takes one deal. That deal, we had $1 million value add, and I think the renovations cost less than 10 grand to make $1.3 million. There's still sales fees if we sold it, but we're not going to sell it, refinance it. We bought a 0 down, 10 grand in, fix up. We had to add 2 kitchens, and pull out a couple $100 grand. You can live on that for a little bit. So it just comes down to buying deals that are the right size that aren't going to take you 5 years. So if it takes you too long, you lose interest, and you lose the urgency to actually make it happen. one deal can get you there in less than a year. And now you're balancing the Job Act with, I'm going to play full-time real estate investor. You get a $200,000, $300,000, $400,000 cash out, you can go full-time, and you can figure it out for a couple of years.
And so, just reiterate again, what's the difference between making $100,000 income in your job and then versus refinancing and putting $100,000 worth of cash?
Well, if you borrow money, it's non-taxable. So if you get $100,000 at your job, you're probably gonna net after taxes. I mean, it depends on the state. Anywhere from, if you're in Cali, I mean, maybe 55,000 up to 70,000. After you pay for all your taxes, and so the amount of extra money you have, if you cash out, you get $100,000 versus $100,000 at your job, could be $30,000 to $45,000 difference, which is a lot. So, if that, Ahmed.
So my question is like, I've been looking at a lot of multifamily properties, and pretty much all the sellers are claiming that their rents are below the market, like whenever they're trying to sell their properties.
Uh-huh.
It's very difficult for me to verify or like identify which ones are like lying or which ones are accurate. So you're also like talking about like increasing the rent, which makes a lot of sense. But when I'm analyzing the deal, I don't know how to approach it. I don't have a good way of analyzing it.
Rentometer.
Yeah.
Tool. Because it'll just give you an average for the area of that size, like apartments or houses. So you can set up apartments, 2-bedroom, 1 bath, and give it the address of the property you're looking at, and it'll tell you what the 2-bedroom, 1 baths are getting all around you. And there's a free version, and you can do a few of those, and I mean, it's only $100 a year if you want the pro version, and you can like run reports, and it'll tell you exactly what every unit is getting in that neighborhood. So that gives you your baseline for if you can raise rents or not. You'll know if you're the average, the upper percentile. Awesome tool. I mean, I use it every day
Right.
when I'm looking at deals. That's
Great. You can also go incognito and call as a tenant. Call up the local PM company. Say, hey, how much is it going to cost to rent a 2-bed? You just say, me and my wife just moved into town. We need a 2-bedroom for us and our kid. How much would it cost and when can it move in? Then you can gauge if there's availability, number one, and two, how much it's going to cost. And you can see, okay, what's the deposit? And you can start comparing, okay, well, people that charge $2,500 only have a $500 deposit. People that charge $2,000 have a $1,000 deposit. People that charge $1,895 are charging full month of deposit. And the people that charge a smaller deposit get higher rent. Absolutely. So you can gauge which type of manager you want to be.
And then follow up on Juan's question. I know that rents have been increasing a lot in the Seattle Puget Sound area, and I don't know what the laws are, but I've heard a lot that there are some requirements as to how far you can move rents.
Mm-hmm.
And maybe a lot of those people are, they're trying to push it as hard as they can, but they haven't been able to maximize it for the time delays. Is that something that is the case in this area, or?
It's definitely tough. You can't just say, hey, your rent's going up in 30 days. That's not going to happen in Washington State.
Okay.
Yeah.
That's what I was wondering.
So you should budget time. If you're in Seattle, I think it's 6 or 9 months, somewhere in there. I mean, it's a long time to bump rents. One thing that you can do to get just a little tip to get a little higher rent, it matters more on these buildings than it does on a fourplex because the value is based on the income. If you offer someone, let's say their rent is $1,000, and you say, hey, look, I'll give you half off first month or 3/4 off first month if you sign a lease for 13 months at $1,100. You can figure out basically how to get the same amount of income in the year, even though you're giving that massive discount the first month, but your NOI is valued significantly higher.
Can you just repeat that real quick? I thought that was kind of. Can you repeat that?
Yeah.
Real quick?
So let's say, let's say that you're renting something out for $1,000, and instead of $1,000, you say, hey, look, I'll give you first month off if you sign a lease at $1,100.
So you've decreased their actual outflow of cash, but you've increased your rent rolls, which made your property more valuable.
Mm-hmm.
You gave them a discount to make yourself wealthy.
Yep. You boost the value, and the likelihood of them moving out after 13 months, and we see that most people stay for 2 to 3 years, So if you can arbitrage the fact that you're just getting a higher income, you make the same amount in the first year, but you're betting on the fact that they're likely to stay there because you manage it better than other complexes. And if they sign that second lease, not only are you at a higher rent, you don't have to do a rent bump then, but you get a higher value day one. And if you want to sell it and 1031 it or sell it to someone to get cash out, pay off other stuff, you can push your values up really quickly just by doing that.
Can you do that before the lease term ends? I mean,
Well, you can't make them do that, but you could offer it to them. Just like
even if they're in the middle of the lease?
you can always offer something.
Okay.
Just like I could offer Christian $1 million for his share in the Robinhood, which I'm not doing. But I could absolutely do it. He doesn't have to do it because we have an agreement already signed that says we are splitting it half and half.
But if they want to, then you can make it do it.
Yeah, it's just like, hey,
Okay, that makes sense.
rents will be going up in 3 months when your lease is up. If you'd like, we could sign a new lease now. You'll get 1 month off, and then your rent's going to be X. This will give you time to save up for the additional payments, and that way it doesn't make you look like an evil person, evil capitalist, and you can boost your NOIs really quickly and not wait for a 12-month lease term.
The bank loves it.
Absolutely. Ashley?
When you're just starting out, and you're trying to raise money, do you think that being able to explain the math is like the major selling point in getting those investors on board, or like what was the biggest thing in convincing them to buy into your deal?
Math is important, but I will say when I did my first investor pitch, I was on a whiteboard, and I was in a building in downtown Tacoma. I'm not naming names because that guy went bankrupt. But I started making a pitch, and I went to write on the board, and I forgot the purchase price. I forgot the interest rate. I forgot what the payment was and what the income was. And so I stood there like this. Except for this wasn't here. It was just a whiteboard. So the math is important, but there's only 3 things that matter when raising money. People think there's some long list, and there's not. Number 1, where's the money going? That people skip that for some reason. So if you're buying a 12-plex, and let's just say this is number 12, a little slanty 12-plex, you're buying that. That's where the money's going. Show them a picture. This is why I always start with Google Maps. This is where it's going. Number 2, what's the stability of what's backing it? If this is in Detroit way back when, probably not super stable. But if you go far enough back, people are like, oh, that makes sense. So you have to find a stable market where you're going to have consistent cash flow. You don't have any impending balloons. If you've got a 2-year balloon, it's not a very stable deal because they're going to put money in the down payment. And if you can't get the loan, they're going to lose it. So you want long-term fixed rate debt, stable cash flow, decent location, or an area that you can fix. And number 3, how are they getting paid back? If you answer those 3 things, you can raise money from anybody. Where's it going? What's the stability? How do I get paid? And how do you get paid? Could be the math. Could be, well, I bought it for my first deal, bought it for $1,125,000. After I botched that pitch, I had another one, and I wrote down on a little sticky note so I remembered. But buying for $1,125,000, it's a corner lot. If I just get the rents, there's a spread. Some of them are at $875,000, $900,000. Some of them are at $700,000. If I get them to the $900,000, it's worth close to $1,500,000. Buying it for $1,125,000. And if I can't pay you back, which I will do with the asset in a refi, if I can't do that, I'll sign over the property, and you'll have all this extra equity. So I show them how they get paid back, either scenario. The stability of it, the asset was completely full. There was no vacancies, and there was next to no rental listings on the market. The market was full. So that's how you raise money. And the math is important, but I forgot all my math on my first pitch. I still work.
So if you're playing with the million or whatever, and trying to find like a 20 unit, if you're starting now in this environment, what would you be looking here in Washington, or like?
You just pick a market, and the main thing is there's nobody that can help you more in real estate than the people who own in the market that you want to own in. So regardless of the market, there's debt markets and equity markets. Debt markets are where people lever up. That's going to be like Seattle. Everything is flashy. Let's go buy really big stuff, and let's borrow as much money as we can. Same with Tacoma. There's equity markets like Grant County, where I got started. Now there's more debt because young people that don't have money go lever up there. And so that's what I did in Moses Lake, but over 40% of all real estate there was owned in cash when I started buying there. And there are metrics on that online. But you have to find those equity markets, and that'll increase your odds of success in the business.